Assalamualaikum warahmatullahi wabarakatuh. So today I am Syaima Atika and my friends Fanny Dwi A.P will present and explain about capital set pricing model and arbitrage pricing theory. So the first one, let's see what is capital set pricing model means. So it is a model that relates the required rate of return on a security to its systematic risk as measured by beta. So actually, capital set pricing model is widely used in the financial world to assess risky stock and calculate the estimated return on risk for this asset and the cost of capital. So the relationship between the required rate of return on security to its systematic risk serve two important functions. The first one, it provides a reference rate of return to evaluate investment possibilities. And the second one, capital set pricing model help us to make an educated guess as to the expected return on assets that have not yet been traded in the marketplace. Okay, next. So what are the assumptions of the capital set pricing model? So actually there are so many assumptions in this model, and it includes our investor will think in terms of a single holding period, and all information relevant to security analysis is publicly available at no cost, and all investors are the price takers. It means that investor buying and selling won't influence the stock price. Okay, next. So this is the efficient frontier and the capital market line. So in this graph, we can see that the straight line is connecting a risk-free asset with the market portfolio, and there is the tendency point between this free asset with the market portfolio. And actually, risk-free rate is normally taken as the yield on the long-term government bond in the country where the project or company is based. Okay, next. So actually, what is the capital market line means? It is a linear combination of risk-free asset and market portfolio. And portfolio below the capital market line are inferior. This is because capital market line divides the new efficient set, and all investors will choose a portfolio on the capital market line. Why? It is because unrealistic investor must choose the portfolio that provide the biggest returns with the same particular risk. And because the most profitable point is in market portfolio, it means our investor will definitely invest at this point. Okay, next. Okay, next, so actually what is the security market line means? So it is the graphical representation of the expected return beta relationship of the capital set pricing model. So the beta of a security is appropriate measures of its risk because beta is proportional to the variance the security contributes to the optimal risky portfolio. And the differences between fair and actual expected rates of returns on a stock is called as alpha. So let's see this example. So to predict an expected return on the stock, we use this kind of equations where the T-bill rate was estimated as 6, and then we plus with the beta, which is 1.2, and then multiplied by the return on the market is expected to be 14, and then minus with the T-bill rate, and the total is 15.6%. Okay, next. Okay, so this is the application of the capital set pricing model. So many people still confused and still questions about the application of capital set pricing model into real life. So this is the answer. Capital set pricing model may be used in the investment management industry, and then also useful in the capital budgeting decisions. And another use of the capital set pricing model is in utility rate making case. Okay, for the next slide will be explained with my friends Fanny.
Thank you, Syaima. So I will continue the presentation. So predicting betas. So the systematic risk is approximated well by the regression equation beta, and non-systematic risk by the residual variance of the regression. As an empirical rule, it appears that beta exhibit a statistical property called mean reversion. So we can suggest that first is high beta. It means that beta is over than 1. It makes that a lower beta in the future. And the second one is low beta. It means that beta is lower than 1. It makes that a higher beta in the future periods. So most stocks have beta in the range of 0.5 to 1.5. So Are there problems with the CAPM test? So yes, it is. Richard Rowe already questioned it before. So Rowe argued that the true market portfolio can never be observed. The usual stock market indexes used as proxies for the market portfolio ignore the large majority of investor wealth. So without a good measure of the return on a broad measure of investor asset, the theory is necessary untestable. So what are our conclusions regarding the CAPM? So first is it is impossible to verify, and the second one is recent study have questioned its validity, and the third one is CAPM or single market line concept are based on the exception. Yet beta are calculated using historical data. A company historical data may not be reflect investor expectation about future riskiness. Next, so there are another models to calculate expected rate return. So there is arbitrage pricing theory. So arbitrage pricing theory is APT, is multi-factor asset pricing model that is influenced by the macroeconomic variable that capture systematic risk, and the estimation of the expected in APT is not really much influenced by the market portfolio as in the CAPM. And the formula in the that we use in the arbitrage pricing theory, this kind of formula, and the RI is rate of return on stock, and the alpha is for the expected return on the security, and the beta is for the sensitivity of the stock return, and times 2 factor. F means that systematic factor, and plus 2EI. It means that firm specific risk. Next, so what is the difference between the capital asset pricing model and the arbitrage pricing theory? So actually CAPM is a single factor model, while the APT is more complex, and it is a multiple factor that such as expected inflation, tax rate changes, and the dividend yield. So that's all our presentation. Thank you very much. Wassalamualaikum warahmatullahi wabarakatuh.